By offering health insurance coverage and retirement savings options, employers provide greater opportunity for employees to have a better quality of life and even save money. Some of these plans include health care plans, savings plans, and paid time off benefits. The Patient Protection and Affordable Care Act, or PHRca, requires all employers with more than 50 full-time equivalent employees to provide health insurance benefits. California employers are required to provide the same level of health insurance benefits as is required nationally. However, under Assembly Bill 1602 and Senate Bill 900, the state of California set up Covered California, which was the first insurance marketplace in the United States. Under Covered California, small employers, meaning those employing between 1 and 49 full-time equivalent employees, can purchase health insurance through its Covered California for Small Businesses, or CCSB. However, small businesses must have at least 70% of their employees participating in order to purchase their coverage as the employer, and must also have at least 51% of its workforce located in the state of California. Unlike the employer contribution percentages under PHRca, small businesses purchasing coverage through CCSB are only required to contribute 50% of the cost of coverage for its employees. Small businesses purchasing health benefits through CCSB and then crossing the threshold into more than 50 full-time equivalent employees will not be terminated from the plan and will be allowed to re-enroll in CCSB. However, employers with 50 to 100 full-time equivalent employees are considered eligible through not only coverage with CCSB, but will also be required to offer health coverage as an applicable large employer under the ALE plans. On June 26, 2015, the United States Supreme Court issued a decision regarding same-sex marriage. The decision guaranteed the right of same-sex couples to legally marry throughout the United States. This decision affected every state in the nation and required that all rights and privileges afforded to spouses be afforded to spouses in same-sex marriages. This decision came 2 years to the day after the U.S. Supreme Court upheld a lower court ruling in California that held that Proposition 8, which did not allow same-sex couples the right to legally marry in the state of California, was unconstitutional. Employers need to make sure that their plans are consistent with the Supreme Court ruling. Senate Bill 30 expands the current definition of domestic partner effective January 1, 2020. The California domestic partnership is a legal relationship available to all same-sex couples as well as opposite-sex couples. It affords the couple the same rights, protections, and benefits, as well as the same responsibilities, obligations, and duties under law as married spouses. Enacted in California in 1999, the Domestic Partnership Registry was the first of its kind in the United States. California employers are required to offer the same rights and benefits provided to all spouses to registered domestic partners. This includes making health care decisions for each other in certain circumstances, access to family health insurance plans, spousal insurance policies, sick care and similar family leave, presumption that both members of the partnership are the parents of the child born into the partnership, access to some survivor pension benefits, and the right for either partner to assume or take the other partner's surname after registration, the right to request partner support upon dissolution of partnership, and the same parental rights and responsibilities granted to and imposed upon spouses in a marriage. To become a registered domestic partner, domestic partners must be over 18, or one or both partners under 18, and have obtained a court order granting permission to establish a domestic partnership and meet the requirement of California Family Code Section 297 that they may register a domestic partnership with the California Secretary of State. Partners may register by completing a Declaration of Domestic Partnership, Form NP/SF DP-1, having both partners' signatures notarized and submitting the form with the appropriate fee to the California Secretary of State. It creates some differences between California and federal law in the administration of benefits and leave. For example, an employee requesting leave to care for a registered domestic partner under the California Family Rights Act does not qualify for leave under the Family Medical Leave Act. In this situation, an employee would be eligible for protected leave under CFRA for this instance, and can also be eligible for protected leave at a later time in the same 12-month period to care for a child under FMLA. Assembly Bill 17, which was signed into law on October 10, 2003, affected all contracts with the state of California executed or amended after January 1, 2007. Under this law, any organization, whether inside or outside the state of California, that is granted a contract with the state of California for $100,000 or more must provide the same benefits to registered domestic partners as it does to all spouses. In addition, Assembly Bill 2208, the California Insurance Equality Act, signed into law on September 13, 2004, requires all health insurance providers to extend coverage to registered domestic partners as it does to spouses. The only exemption to this law is organizations that self-insure. The California Continuation Benefits Replacement Act, Cal-COBRA, passed in 1997 and is an extension of the Federal COBRA program. Cal-COBRA and the Federal COBRA program provides benefits continuation after a qualifying event that ends employer-sponsored coverage. Cal-COBRA extends standard COBRA benefits to non-government organizations in the state of California with 2 to 19 employees. Federal COBRA programs cover organizations with at least 20 employees. Under Cal-COBRA, employees are offered up to 36 months of coverage continuation, whereas COBRA's offers may be limited to only 18 months. Employees or dependents who exhaust their COBRA coverage can apply for additional time up to a total of 36 months under Cal-COBRA. Cal-COBRA also has an extended period of coverage for retirees and their beneficiaries. Employees who are at least 60 years old and have worked at least 5 years with their last organization are entitled to COBRA coverage extension for at least 5 years. Former employees must have this coverage available to them until they accept another health plan, stop participating in a health plan, accept Medicare, or are at least 65 years of age. The California Domestic Partner Rights and Responsibility Act of 2003 affects the administration of Cal-COBRA and COBRA as well. A California employee's registered domestic partner would be offered Cal-COBRA coverage for an employer with 2 to 19 employees and would not be offered COBRA coverage from an employer with 20 or more employees. Employers must notify employees about the right to continue coverage when a qualifying event that results in the loss of group eligibility occurs. Employees must sign up with the health plan within 60 days of receiving notice of eligibility for Federal COBRA or Cal-COBRA. Employees are responsible for the entire cost up to 102% of the group rate under COBRA, For Cal-COBRA, the cost may range from 110% to 150% of the group rate. Along with Cal-COBRA, California's Health Insurance Premium Payment or HIPP program can assist individuals that are losing their employer's insurance coverage because of their own medical condition. The California Department of Health Care Services will pay health insurance premiums for certain persons who are losing employment and have a medical condition that requires a physician's treatment. Employers must notify individuals that are losing their health insurance of the availability of HIPP. A standardized notice is available from the California Health and Human Services Agency, or DHS. This notice informs the terminated employee of the existence of the program and the eligibility requirements. To qualify for the Health Insurance Premium Payment Program, the individual must meet all of the following requirements. They must have full scope or fee-for-service Medi-Cal. They must have a medical condition that requires a physician's treatment. They must meet the cost-effectiveness analysis criteria, have a current health insurance policy that covers their medical condition, be enrolled in COBRA or Cal-COBRA continuation policy, or a COBRA conversion policy in effect or available at the time of the application. They must have a health insurance policy that covers their medical condition. They will need to apply online, upload all necessary attachments. They cannot be enrolled in a Medi-Cal managed care or prepaid health plan, county organized health system, or geographic managed care or Medicare plan. Flexible spending programs are employer-sponsored benefits that allow employees to set aside funds to cover the cost of expenses for health and wellness care, dependent care, or other qualified expenses. These programs work on an annual plan year basis and are funded through regular payroll deductions on a pre-tax basis. California law requires companies that offer flexible spending programs notify employees participating in the program of any deadline for withdrawing funds before the end of the plan year. Notices may be provided by email, telephone, text messages, postal service, and in person. The notices must be provided in 2 different forms, but only one form may be via an electronic communication. In December 2018, California announced the start of its CalSavers retirement savings program for private sector workers whose employers do not offer a retirement plan, and self-employed individuals and others who just want to save extra money. Employers with 5 or more employees must participate in CalSavers if they do not already have a workplace retirement plan in place. Employers are required to either implement their own retirement plan or sign up with CalSavers by the following dates. Employers with over 100 employees must enroll by September 30, 2020. Employers with 50 or more employees must sign up by June 30 of 2021. And employers with 5 or more employees must enroll by June 30 of 2022. For the employer, they must only offer the plan to their employees. It is not their responsibility to ensure or require that their employees participate in the CalSavers program. After registering for the program, employees will be notified and given 1 month to opt out before they are automatically enrolled. Employers will have no liability for the investment decisions of participating employees. They will not be the fiduciary of CalSavers, nor will they bear any responsibility for the administration, investment performance, or the payment of benefits earned by participating employees. In the CalSavers program, savers contribute to a Roth Individual Retirement Account, or IRA, that belongs to them. The default savings rate is 5% of gross pay, but savers can adjust this rate at any time. Savers can opt out and back in at any time, and their account remains portable. It stays with them even if they leave the workplace. In order to be exempt from the requirement to join CalSavers, employers must offer one of the following retirement savings plans: 401A, 401K, 403A, 403B, 408K, 408P, or a 457B, and register their plan with the state by the deadlines listed. If an employer does not provide their own retirement savings plan or register their organization for the CalSavers program by the required deadline, they may be subject to penalties of $250 per employee if they do not comply within 90 days of receiving notice requiring registration, or $500 per employee if the employer does not comply within 180 days of receiving the notice. Providing employees with time off benefits in California is both required, as in paid sick leave, and optional, as in vacation. However, even optional benefits like vacation have specific rules that must be followed if provided.
California Healthy Workplaces, Healthy Families Act requires all employers to provide paid sick leave to most employees who work at least 30 days in the state of California. The law specifies that sick leave can be given in several different ways. So you can load it up front, or you can put it on an accrual basis where it's no less than 1 hour per every 30 hours worked. Or it can be accrued in some other way as long as there's at least 24 hours by the 120th day and 40 hours by the 200th day. Eligibility and use. Eligibility requires that an employee be employed by their current employer for at least 30 days before sick leave may be accrued. The employer can limit use to after the first 90 days of employment. Employers can cap accrual at 80 hours per year and can limit the use of accrued paid sick leave to 40 hours or 5 days per year, calendar or anniversary. Use of paid sick leave can be required in increments of at least 2 hours. Paid sick leave can be used for the diagnosis, care, or treatment of an existing health condition or preventative care for themselves or a qualified family member. It may also be used when the employee is a victim of domestic violence, sexual assault, or stalking. Under this law, a qualified family member is a child, a parent, a spouse, a grandparent, a grandchild, a sibling, and actually any designated person.
Employers are required to approve sick time requests whether given orally or written. When utilizing paid sick leave for preventative care, that is, treatment that was scheduled in advance, the employee must provide their employer with sufficient advance notice. If an injury or illness was unforeseen, the employee must give notice as soon as practical. Employers are advised not to request medical certification for use of sick leave unless that certification is necessary for administering another leave of absence request. When utilizing paid sick leave, an employee should be compensated at their regular rate of pay. If the employee received variable rates of pay, the employer can decide to utilize one of two methods. First, they can average the straight time wages over the immediate 90 days preceding the use of the sick time. Or second, they can average the straight time wages for the pay period during which the sick time is being used. Since paid sick leave is not required to be paid out to employees at termination, Employees that are reinstated within 1 year of their termination are required to receive and have available all accrued and unused sick time at the time of rehire. If an employer utilized a qualifying PTO or paid time off plan and has paid out all accrued and unused PTO at the time of the employee's termination, there is no requirement to reinstate any sick time. This act prohibits employers from discriminating against employees who exercise their sick leave rights under the law. Employers who have policies regarding disciplinary action after tardiness or absences should ensure that their policy does not utilize these protected days in their disciplinary determinations. The law also prohibits employers from requiring their employees to use sick leave.
When applied to employees working under an approved alternative workweek schedule, those employees should receive at least 5 days of paid sick leave. Employees working 4 10-hour days should receive 50 hours of paid sick leave. When applied to employees who work less than 8-hour days, those employees should receive at least 40 hours of paid sick leave. Employees working 5-hour days should receive 8 days of paid sick leave.
California organizations are not legally required to offer vacation time benefits. However, as with many other voluntary benefits, once an employer does offer vacation, there are rules and regulations about its administration. Under California law, vacation is an accrued benefit and is therefore considered wages. All unused accrued vacation at time of termination shall be paid at the employee's final regular rate of pay, not at the employee's rate of pay when the time was earned. Because of this, earned vacation cannot be taken away from the employee. Use it or lose it, vacation policies are illegal. Employers cannot require employees to forfeit accrued or unused vacation or PTO time for any reason, except by limiting accrual when a reasonable cap is in place. To control potential problems with large accrual banks, employers may implement a reasonable cap at which vacation or PTO will stop accruing, limit carryover from year to year to a reasonable amount, and/or allow or require unused vacation or PTO to be paid out at the year's end. The Labor Commissioner's guidelines put this limit at 1.75 times the employee's annual rate of accrual. When utilizing vacation, employers must pay employees based on their regular rate of pay. For commissioned employees, the rate of pay can be either an average of earnings over a reasonable amount of time or a set hourly amount regardless of earnings. To avoid disputes, employers should determine which method of pay will be used in advance and explain it in the employee's commission agreement. Employers can approve or deny an employee's request to use vacation, can require them to provide a set limit for notice of vacation needs, can schedule employees to utilize their available vacation, and can provide blackout periods when employees may not use their vacation. Employers can also determine the minimum amount of time that can be used for vacation, for example, 15 minutes, 30 minutes, 1 hour, and so on. Allowing an advance of vacation or a negative balance is at the discretion of the employer. However, time not recouped cannot be deducted from an employee's final wages if terminated without the employee's approval. Best practice, employers should require employees to complete a vacation request form or similar when requesting time off for vacation. In Ria v. General Atomics, the California Court of Appeal issued an important ruling confirming that employers may require salaried exempt employees to use accrued vacation or PTO time for partial day absences in any increment, including increments of less than 4 hours, without violating the salary basis requirements for exempt status under California wage and hour law. Employers can also decide whether or not they will allow their employees to go negative in their vacation balance. However, there are consequences of allowing negative balances when it comes to the employee's termination. Employers may not require employees to pay back that lost time. Please see the compensatory wage and hours section for more information.
Paid time off, PTO, is the combination of sick and vacation time. Employers utilizing a PTO policy allow employees to take their vacation time for whatever reason they would like. Similarly, for vacation time, employers can dictate guidelines as to how the PTO can be used. However, California employers that utilize the PTO program need to be sure that their policy allows use for at least 40 hours or 5 days for sick leave under California's Healthy Workplace, Healthy Families Act. This time must be held to less strict standards than the remainder of the available time. Like vacation time, PTO is earned time and is therefore compensable at time of termination. Under California law, care refers to time off an employee may need in order to care for a sick child, parent, spouse, registered domestic partner, or child of a registered domestic partner. Prior to July 1, 2015, employers were required to allow employees to use half of their annual accrual of sick time for kin care. With the enactment of California's Healthy Workplaces, Healthy Families Act, employers must allow employees to use at least half of their annual accrual of sick time for kin care, but no less than 5 days or 40 hours.
Partial wage replacement programs are designed to help employees that miss work because of an injury or illness to themselves or a family member that a doctor or medical provider certifies that the employee is unable to work and therefore causing the employee a loss of wages. California's partial wage replacement programs include California State Disability Insurance, Paid Family Leave Insurance, Unemployment Insurance, Work sharing, and workers' compensation. Wage replacement is determined by calculating wages earned during an individual's base period. Weekly state disability insurance and paid family leave benefit amounts are calculated using this base period. Your benefit amounts are based on the quarter with the highest wages earned within the qualifying base period. This base period covers 12 months and is divided into 4 consecutive quarters of 3 months each, as seen on the chart below. Depending on when the claim is filed, the wages an individual was paid in the previous schedule are included in the base period. For a claim to be valid, an individual must have wages in their base period. The wages must have been subject to the SDI tax to qualify. The base period does not include wages paid at the time an individual's disability need to be off to provide family care or to bond with a new child begins.
California State Disability Insurance. Most California employers are covered by California State Disability Insurance, which is funded by a payroll deduction from employees. In the event an employee finds themselves disabled or unable to work their normal schedule, state disability insurance benefits can be used to offset some of the reduction in pay they will receive from a reduction or complete stoppage of work. Employers may not be covered by California State Disability Insurance, including individuals performing ministerial duties, school districts and local government personnel, state employees, individuals who rely on prayer for healing, and individuals performing domestic service. Benefits are payable for a maximum of 52 weeks. Your weekly benefit amount is approximately 60 to 70% of wages earned 5 to 18 months prior to your claim start date. Beginning in 2025, employees making less than 70% of the California state average weekly wage will receive 90% of their wages as their benefit amount. To receive state disability benefits, an individual must file a claim for disability insurance benefits using state disability insurance online or paper claim form. Serve a 7-day non-payable waiting period, does not apply to paid family leave, by the way. Have at least $300 in wages that were subject to state disability insurance contributions during the 12-month base period. Have the physician practitioner certify to your disability by completing the physician practitioner certification. If an employee is utilizing sick time benefits to offset their loss of wages, the amount of sick time pay will be considered wages and will reduce the employee's state disability insurance benefits. Employers can require or the employee can request to use accrued and unused vacation during time off without reducing state disability insurance benefits. There are 3 disability insurance plans administered by the Disability Insurance Branch of the EDD. We have the state plan, which covers the majority of employees. There's also a voluntary plan, which can be established if the employer and the majority of the employees agree. And then there's elective coverage, available for small business owners or self-employed individuals. Although the administration of this benefit is through the EDD, employers are still required to inform employees of their rights, make the proper payroll deductions, submit the money to the state, and file required reports. Employers can be liable for penalties if the information or withholdings provided to the state are incorrect. For more information about California State Disability Insurance, visit the California website at https://www.edd.ca.gov/about_di.htm.
Employers working for public agencies are not entitled to income reimbursement through California's state disability insurance program. However, they are entitled to up to 1 year of paid leave because of a disability. This paid leave will continue for 1 year or until the employee is considered retired and receiving permanent disability pension payments, whichever comes first. All employees are covered by paid family leave or PFL benefits and can receive partial wage replacements for up to 8 weeks in any 12-month period. To be eligible for PFL benefits, an employee needs to be unable to work or only able to work a reduced schedule because they need to care for a seriously ill or injured family member or to bond with a newborn, newly adopted child, or newly placed foster child. Benefits typically equal 60 to 70% of an employee's earned wages in the highest quarter of their base period. The employer can require their employee to take up to 2 weeks of accrued and unused vacation or paid time off before utilizing PFL. Or employees may elect to use accrued vacation or PTO to supplement their PFL benefits. This is called integration. Combined PFL benefits and paid leave can be up to 100% of normal wages, but cannot be more than normal wages. If the employee is receiving benefits from SDI, unemployment compensation, or workers' compensation, they are ineligible to also receive PFL benefits at the same time. The employer must provide notification to all employees, deduct proper withholdings, and submit to the state, file reports to the state, and properly track the time employees use under PFL. In addition, it is important to know that interactions between state disability insurance and paid family leave for pregnant employees, an employee out on PDL can collect SDI benefits during this time. Once she is no longer disabled because of her pregnancy, she will stop collecting SDI benefits and can receive PFL benefits while on CFRA. The Employment Development Department, or EDD, provides all posting and notice requirements for employers pursuant to SDI and PFL benefits. Employers are required to post the notice to employees in a prominent location that is normally accessed and easily seen by all employees. The California Tax Service Center requires that upon date of hire, employers are required to provide to all employees DE 2320 for your benefit, California's programs for the unemployed. The Employment Development Department requires that when appropriate, employers provide to all employees for your benefit, California's programs for the unemployed, disability insurance provisions, and paid family leave brochure, explaining the employee's rights under all of these programs. Employers are also required to provide employees requesting leave to care for a seriously ill family member or to bond with a new child the paid family leave notice. It is the requirement of the employer to keep appropriate documentation and records pertaining to all leaves and in addition to time off under SDI and PFL. The appropriate reports with regards to wages provided to employees who are taking advantage of SDI or PFL benefits should be filed with the EDD when requested, as these wages may adjust the benefits offered through these programs. The complete listing of documentation and record retention requirements is listed in the Employee and Employee Relations section. The Unemployment Insurance Program provides financial assistance to individuals who are temporarily out of work through no fault of their own. In California, this program is financed entirely by employers. Employees are eligible for unemployment benefits when they are terminated through no fault of their own, meaning the employee is terminated at will or during a layoff, they may be eligible for unemployment benefits. Conversely, if an employee quits or is terminated for cause, they should not be eligible for unemployment insurance benefits. It is important to note, however, that under the California Unemployment Insurance Code 1256, an employee may be deemed to have left his or her most recent work with good cause if they left the employer to protect his or her family or himself or herself from domestic violence abuse. Therefore, it is important for employers to understand how the unemployment insurance process works, as all terminated employees are eligible to file for unemployment, and it falls on the employer to provide the information necessary for the board to make proper determination as the claimant's eligibility. When employees file for unemployment benefits, they must provide to EDD information about their last employer. EDD and the employer then become partners who work together to exchange information that is necessary in determining eligibility for unemployment benefits. The information is gathered through various notices and forms that are time sensitive. The notices are the primary method by which employers can provide eligibility information to manage their reserve accounts and assist EDD in making proper eligibility decisions. The first notice an employer will receive is the Notice of Unemployment Insurance Claim Files. This notice is mailed to the very last employer when a claim for unemployment benefits is filed. It provides general information about the claim, including the reason the claimant states they are no longer working. This is the first opportunity the employers have to provide eligibility information by responding in writing and mailing the response of the notice within 10 days of the date located at the top of the notice. A timely employer response guarantees a written notice of determination and ruling from the EDD and the employer's rights to appeal the EDD's determination. Once an initial determination has been made, the employer will receive the Notice of Determination ruling. This notice advises employers of the EDD's decision regarding the claimant's eligibility for unemployment. It provides a reason for the decision, the applicable section code of the unemployment insurance law, charges to the employer's reserve account, and appeal rights. Appeals must be in writing and received within 30 days from the mail date located at the top of the notice. If unemployment benefits are awarded, the employer will receive the notice of wages used for unemployment insurance claim. This notice advises employers of the percentage of benefits chargeable to their employer reserve account. This is the second opportunity for the last employer and the first opportunity for any other base period employers who were not the last employer to provide eligibility information by responding in writing and mailing the response within 15 days from the mail date located at the top of the notice. Employers can request a ruling to have the liable charges relieved from their reserve account with EDD, and EDD will determine whether the charges are assessed. There are also instances in which employer may receive notification from EDD in request of information. Situations where a current unemployment benefit recipient begins employment with your organization, or when a current employee both works for you and received unemployment benefits for the same weeks. When this occurs, the organization may receive one of the following: a new employee registry, or a benefit audit, or a request for additional information. In any instance, employers should be quick to complete and return any information that is being requested by EDD. In most circumstances, the provided information is being compared to both information received by the claimant as well as the organization's own payroll records to make a determination. The more information they have at any step of the process, the better. Senate Bill 271 ensures full access to California's unemployment insurance, state disability insurance, and paid family leave benefits for motion picture production workers who are residents of California and work out of state on productions, as long as the employee is hired and dispatched from the state and intends to return to seek reemployment. The work-sharing unemployment insurance program allows payment of benefits to employees whose hours and wages have been reduced. This program was established by the California legislature to help employers avoid some of the burdens that accompany a layoff situation, and is considered an alternative to layoffs. Any employer who has a reduction in production, services, or other conditions that cause the employer to seek an alternative to layoffs can consider participating in the work-sharing program. As with other wage replacement programs, there is a 7-day waiting period before benefits kick in. The advantage of work-sharing includes allowing employers to retain trained employees until business conditions improve. It enables employers to avoid the expense of recruiting, hiring, and training new employees. It minimizes or even eliminates the need for layoffs and accompanying hardships for the employees, and it can be used to prevent layoffs in almost all types of business or industry. Employers must meet all program requirements to be approved by the Employment Development Department to participate in the work-sharing program. Leased, intermittent, seasonal, or temporary service employees may not participate in the work-sharing program. Corporate officers or major stockholders with investment in the company may not participate in work-sharing program. The work-sharing program cannot be used as a transition to a layoff.
If you learned a little something about California in this video, please like and subscribe. I will drop a link in the comments below for a free download with more information about the Professional in Human Resources California certification.